All right, welcome. Today, we're going to break down a concept that, honestly, is the difference between traders who are always frustrated and the ones who are consistently profitable. We're talking about liquidity. We are going to completely flip how you look at the market, turning those really painful losses into actual winning strategies, all by thinking like the big players. So let's kick things off with a feeling I'm almost certain you know way too well. So let me ask you this. Have you ever been in this exact spot? You've done all your homework, the analysis is perfect, you get into a trade, you set your stop loss, and bam, the market sends down this one single wick, just taps your stop, takes you out, and then almost immediately it reverses and rockets right to your original target, but without you. It is one of the most infuriating things in trading, and I'm here to tell you it is not just bad luck. There is a very specific reason this keeps happening. Here's the good news. The issue isn't you. It's not your fault. The problem is actually baked into the conventional wisdom, the textbook strategies that are taught to almost every retail trader. They're all deeply flawed because they completely ignore the single most powerful force that's actually driving the market. I mean, on one hand, you have what we all learn in Trading 101. See a resistance level, sell it. See a support level, buy it. And of course, put your stop loss just on the other side to be safe. It makes perfect sense, right? But here's the reality. When thousands of traders do the exact same predictable thing, it creates these massive pools of stop-loss orders. And those pools, they don't act like a wall. They act like a giant glowing magnet. They become the target. And that brings us right to the heart of this entire explainer, market liquidity. You have to start thinking of this as the real fuel that moves prices. It's the reason your stops are getting hunted. And truly understanding it is the key to finally getting on the right side of these big moves. So what the heck is liquidity? Well, in simple terms, it's just a dense area of orders. Just think about it. All those stop losses are clustered together. If you're in a short trade, your stop loss is actually a buy order waiting to be triggered. If you're long, your stop loss is a sell order. Now, big institutions, they need to fill enormous positions, and they can't just slam a buy button for $1 billion without setting the price to the moon. They need sellers to sell to them. And where are those sellers? Well, that giant pool of stop losses is a giant pool of guaranteed sellers. They aren't hunting your stops to be mean. They're hunting them because they need your orders to fill their own. So where do we find these giant targets? Well, liquidity always pools in the most obvious places you can imagine. It's sitting right above those clean, equal highs where everyone who's shorting puts their stops. It's sitting right below those clean, equal lows where all the longs have their stops. And you better believe it, it's all along those perfect textbook trend lines that every YouTube video tells you to draw. These super predictable spots are exactly where the traps are being set. And this quote right here, it really says it all. The people with the real power, the ones who can actually move the market, they're not selling at resistance like everyone else. No, they wait for the price to push above it, trigger all those retail stop losses, and then they sell into that sudden wave of forced buying. They're literally playing a different game on a different field. Okay, so now you get the idea of liquidity. But just when you think you figured it out, there's another layer to this, a much more subtle trap that's designed to trick even the traders who know about liquidity hunting, and this is what we call the inducement trap. Think of inducement as a lure, like bait on a hook. It works like this. Imagine the price comes up to a key supply zone and creates a perfect little double top. Retail logic is screaming, "Sell, it's confirmed!" But what's really happening? The market is inducing traders to jump in early. It's building a brand new, fresh pool of stop-loss liquidity right above that little double top, which it fully plans to come back and sweep before making its real move down. It's a trap inside of another trap. Okay, enough with the problems. How do we actually fight back against all this? Well, the answer is to stop trying to predict things and start trading like an institution. We have to wait for them to show their hand. We have to wait for confirmation. So here's the playbook. It's a really simple 4-step process. First, you identify your high probability zone, your supply or demand area. But, and this is absolutely critical, you do not enter yet. Step 2, you have to patiently wait for the market to push past that inducement level we just talked about, sweeping up all that liquidity. Step 3, you watch for a clear signal that the tide has actually turned, a real break of market structure. And then, and only then, on step 4, do you even think about entering on the pullback. You're getting in after the trap has already been sprung. Now, theory is great, but let's make this really concrete. We're going to walk through a simple example to show you exactly how this inducement trap and the confirmation entry play out in a real market situation. Okay, so let's compare these two approaches. The amateur trader, they see the price hit that first, most obvious demand zone, and they jump right in. There's no real signal, it's just price touching a line on a chart. And the result? They get stopped out as the market pushes lower to find more liquidity. But the professional trader, they wait. They see that first zone for what it is, inducement. They wait for it to get swept, they watch for the price to hit the real extreme zone below it, and then they wait for a clear break in market structure to the upside. Only then do they enter, and they end up catching the true institutionally backed move.
And that is why this is so important. This strategy isn't just about finding more winners. It's about systematically avoiding all those low probability trades and those unnecessary, frustrating losses. It's about having a process that actually validates your idea before you put your hard-earned capital at risk. That's what builds real confidence and consistency.
So, to wrap this all up, let's nail down the crucial points. Number 1, those obvious support and resistance levels are not entry signals, they are liquidity targets. Number 2, always be on the lookout for inducement. The market will try to bait you into an early trade. Number 3, your new mantra should be sweep, then shift. Wait for the liquidity sweep, then wait for the market structure shift. And finally, just remember this: patience and confirmation are what truly separate amateur results from professional ones.
So I'll leave you with this one question to really think about. The next time you open up your charts, are you going to see them the old way, as just a collection of random lines and patterns? Or are you going to start to see the deeper story that's playing out? The story of liquidity, where it's building up and where it's about to be hunted next. That choice is going to make all the difference.